Hey guys, how's it going? And welcome to A Story in Every Home. Today I'm going to be talking about mortgages, and I'm going to really focus today on the more traditional type mortgages. That's going to be your 30-year fixed rate mortgage, your 15-year fixed rate mortgage, and I'll briefly kind of talk to you guys a little bit about some of the ARM products out there that you could try to avoid, as well as discuss FHA and VA loans. So let's get started. For me, I'm not a lender. I am only somebody who works with homeowners like yourselves, helping them find the right product, right? So I would absolutely, before you purchase a home, speak with a mortgage broker, get your pre-qualification letter in hand, have the confidence that you're buying the right house for you and your family. The first one we're going to start off with is going to be the 30-year fix. So 30-year fixed rate mortgages are going to be the most common. They're the bread and butter of the mortgage industry. And let me tell you why. So if you were to put down 20% and do a conventional loan, you are going to not pay very much principal at all for the first 5 years of that mortgage. And you know what's convenient? Well, most people move every 5 to 7 years. So sounds really interesting how the way they have this structured. You pay for 5 to 7 years. You really don't put much towards the mortgage, towards the principal, and you end up basically having about as much debt when you leave the house as you did when you first bought it. So 30-year fixed rate is absolutely a great product. I definitely encourage you to get into it, but just keep in the back of your mind, you're not really putting much towards the principal, the balance of your loan, without making an effort and without paying more than the minimum payment. So definitely encourage you to check that out. I've been seeing interest rates right now anywhere between 3% and 3.125%. So I mean that's just record lows. Be sure to take advantage of it if you can. The second product I'm going to talk to you about is going to be 15-year, right? So why would you do a 15-year over a 30-year? The benefits of a 15-year is a 15-year will actually, you'll actually start putting money towards that principal early, right? So when you look at how much money you're paying in principal versus interest over time, the 15-year is almost a home run. And because it's a less of a term, so you don't have to pay for across 30 years, you actually get a lower interest rate on those 15s as well. So that's a huge benefit. Usually 15-year end up being about, I would say probably about 40 to 50% more expensive on the monthly payment than a typical 30-year. Now, if this is your first home and you are scraping and clawing and fighting tooth and nail to get the 10, 20, 30 grand saved up, well, you have products out there called FHA loans, right? So these products are designed specifically for first-time home buyers. Now, I'm going to tell you the benefits of them. A, you get to buy a house. That's about where the benefit ends, okay? So FHA comes with wonderful, it's beautiful, it's the best private mortgage insurance, okay? So if you were doing a 30-year fixed rate FHA loan and you got into your new house and you're excited, that's great. All your money's going towards interest for the most part. Guess what? Now you have private mortgage insurance on top of that, and that is getting funneled over to the insurers. So it's a little bit of a kind of 1-2 punch, but generally the FHA is for people that are kind of just starting their careers or just getting enough money saved up to buy their first home, and that's why it's a good product, right? So that allows you to get in your foot in the door, and then through diligence and focus, you're able to sit there and put money towards that principal every month. You're able to get to that 20% value. That's going to drop off the private mortgage insurance, and you're going to save. I mean, it's an incredible amount. I mean, it's on a mortgage of about $420. I think they say it's like $80 for $80 a month for every 100,000. I think that's what it is. Correct me in the comments, please. We want to make this a discussion. So that can add up to a lot of money. So be sure. Check out with your mortgage broker what that private mortgage insurance is, and make sure you're getting yourself the best rate, okay? And then finally, we're going to talk a little bit about VA loans. VA loans and doctor's loans, They are exactly the way they described for veterans and for doctors. Both come with 0% down. Both are generally more expensive than a conventional, but not always. And that's an important differentiation, right? So if you're looking at a doctor's loan, you might have $300,000, $400,000 in debt, not really be able to qualify for a traditional mortgage, not have the money for the down payment. But guess what? You're a doctor. You make gratuitous amounts of money, and lenders love people who pay interest. And you are a doctor, so you're paying interest because you're going to do it across 30 years, and you're not going to put any towards the principal. So in that scenario, in their mind, they're going to make all the money on you that first 5 to 7 years. They're happy. Same with the VA loan, right? So VA loans are for veterans. Absolutely can be a benefit. The thing you have to watch out for on VA loans is sometimes, depending on the mortgage tables, they can end up being a slightly more expensive than a conventional, right? Now, there is benefits to a VA loan. You can put 0% down. You can do any percentage up there of, and get yourself into a new home, right? So the important thing I would say when you're looking at the 0, 5, or sometimes even 3%, 0, 3, 5, 10, 20% products, is you always want to make sure that when you buy a home, that you have enough money in your budget to buy that. And so how much money can you spend across all these products in a given month? Generally, the rule of thumb is 25% to 33% of your monthly take-home pay can go to your mortgage, and that allows you to what we call not be house poor, right? So if you're early in your career and you have an upward trajectory, you can find yourself in maybe a 40, 42% type product because your income's going up. And that would be something that I would say is okay for your first home. That's not a habit that you want to practice long-term, because that's going to prevent you from doing other things like vacation, investing, college fund, if you have kids, or that could prevent you from really putting any money towards the principal. And what did I say in the beginning? Principal matters, right? That's your money. That's you putting money into your pocket anytime you put it towards the principal. Interest, you're giving it to the banks, you're giving it to Wells, you're giving it to Bank of America, or whoever buys your product. So, when I say product, I mean loan, right? So whoever buys your loan, right? You're giving them money. You're paying their kids' college fund. So lastly, I just want to cover ARMs, which are adjustable rate mortgages. For most folks, I usually see that do these. These are usually for my high net worth, entrepreneurial type folks that are investing heavily back into their business. So they're taking all of their money that they've got, they're in hyper growth mode in their company, and they're pouring it all back in their business. And because of that, they're wanting to keep a relatively low payment. They get a lower interest rate, which is going to lower their payment, and they're going to do what's called an adjustable rate mortgage, right? So that's going to be either 5 years, 7 years, 10 years, and most of the time people will refinance out of it. The only caveat to adjustable rate mortgages is you never really know what's going to happen in the future. And if you did, you'd probably be a billionaire. So my caution with adjustable rate mortgages is if you were to get one, be sure to refinance out of it sooner than later. And of course, you'll have closing costs and other fees associated to that refinance. So overall, we've kind of discussed 30-year in a little bit more depth. We've talked about the good rule of thumb, which is 25 to 33% of your take home. And then we've finished it up with some more peripheral products like the adjustable rate mortgage. Let me know if you guys have any questions. I am looking for video ideas, so leave me one in the comments and I'm going to try to get to it. And of course, subscribe if you like the content. I'm going to be talking design ideas, rules of thumb, architecture 101 here this week. Thanks again and have a great day. Checking the loans. AEIOU. All right, let's do this.